All right. Welcome back, everybody, to the deep dive.
Yeah.
We're going to be, talking about something really fundamental in investing today. Something that Warren Buffett has been saying for years and years and years.
Yeah.
And I think this is the perfect time to get into it, given what's been going on in the markets recently, with all the ups and downs.
Yeah, absolutely.
And today's deep dive, we're going to be looking at this Motley Fool article. The title of it is A Mouthful, but here it is. Warren Buffett's resounding message to Wall Street, delivered over a number of years, couldn't be clearer. And it may change the way you invest right now.
Right. And for you, as somebody who wants to learn things quickly and deeply, but without getting bogged down,
Right.
we're going to kind of pull out the most important parts of Buffett's consistent message as it's presented in this article,
Yeah.
And our goal is to really understand what he's been saying and how it might be useful for thinking about your own investments, especially given the current market situation.
Okay, so let's just start with a little bit about Buffett's investing philosophy in general. I think most people know that he is a big believer in value investing and taking the long view. His track record, it kind of speaks for itself. That's why he's got that nickname, the Oracle of Omaha, right?
Right.
And the article points out something interesting. It says that in the fourth quarter, right before the market took kind of a downturn, his company, Berkshire Hathaway, they actually sold some of their positions in S&P 500 index funds.
Interesting.
Specifically, the Vanguard S&P 500 ETF and the SPDR S&P 500 ETF Trust. I'm curious, could there be other reasons besides valuation concerns?
Yeah, that's a really good question. Obviously we can't know exactly what he was thinking without him telling us directly.
Yeah.
But his principles do strongly suggest that valuation probably played a very significant role. He's historically been cautious about broad market valuations, and those index funds, of course, are going to reflect the overall market, right? So it's possible that he was feeling like the market had gotten a little bit too pricey.
Yeah.
And that fits with his preference for finding specific undervalued opportunities.
Yeah.
Rather than just kind of holding the whole market when it's maybe a little bit expensive.
Yeah. Okay. That makes sense. Now, that actually brings us to the central point of the article, and it's this message that Buffett has been repeating about market downturns.
Yeah.
He's been pretty straightforward about it. He said, the best chance to deploy capital is when things are going down.
Right.
You really can't be much clearer than that.
No, it's pretty blunt.
And to give this a little bit more context, there's another quote from him that the article highlights that I think is really powerful. It's from way back in the 1980s in one of his shareholder letters. And he said that their goal is to be fearful when others are greedy and to be greedy only when others are fearful.
Such a great quote.
It's such a fantastic summary of a contrarian approach, right?
Yeah.
So let's talk about what all of this means in the current environment. The article points out that over the last couple of years, stocks have been on a pretty good run.
Yeah.
There's been a lot of optimism. People were excited about the possibility of interest rate cuts. There's all the hype around AI.
Right.
And all of that led to some pretty high valuations. They even mentioned this thing called the S&P 500 Shiller CAPE ratio, and they said it had reached 35.
Yeah.
For those of us who maybe don't follow that particular metric, could you explain a little bit about what that means?
Yeah, sure. So the Shiller CAPE ratio, basically, it's a way of looking at how expensive the market is compared to historical earnings. So it takes into account inflation, and it looks at earnings over the past 10 years.
Okay.
And when that number gets high, like 35, historically it's been a sign that the market might be overvalued, meaning prices are high relative to what companies are actually earning.
I see.
It kind of gives you an idea that maybe future returns won't be as strong as they have been.
Yeah.
And that the market might be kind of vulnerable to a correction or a downturn.
Okay, so that gives us some context.
Mm-hmm.
And as the article goes on to say, we have seen stocks pull back a bit recently, and there have been some concerns, right, about President Trump's tariffs.
Right.
And the impact they might have on company earnings and, just the overall economy.
For sure.
And in fact, the S&P 500 and the NASDAQ Composite, they both dipped into correction territory earlier this month. Although, to be fair, the S&P 500 has already come back out of that.
Yeah.
But, it's definitely been a bit of a rocky ride lately.
Yeah.
And this is where Buffett's advice really comes into play, right? Because these are the moments, these market declines.
Yeah.
These are when his long-standing message becomes super relevant.
Yeah, exactly.
The article emphasizes this idea that when stock prices fall, the valuations of companies become more attractive.
Yeah. Yeah.
And that this can create, as they say, wonderful opportunities to buy shares in good businesses at a lower price.
Right.
And so this is being greedy when others are fearful.
Right.
Right.
Absolutely.
That's what that looks like in practice.
Yeah.
Everyone else is panicking, selling their stocks, driving prices down.
Yeah.
And that can mean that even the prices of fundamentally sound companies, companies that are actually doing well, those prices can get pushed down too.
Right. Just because everybody's kind of in a selling mood.
Yeah. And so for a long-term investor,
Mm-hmm.
that could be an amazing opportunity to buy into those companies.
Yep.
At a price that's a discount compared to what they might normally trade for.
Exactly. I mean, the article even gives some specific examples like NVDA and Meta Platforms.
Yeah.
Both big tech companies that have seen their stock prices drop.
Right.
And when the article was written, NVIDIA was trading at about 25 times its expected future earnings and Meta at about 24. And so, the article kind of puts them out there as possible fantastic buys for growth investors because the prices have come down. But I think it's really important to remember, it's not just about buying anything that's gone down in price.
Right.
Buffett's whole philosophy is about understanding the underlying value of a business.
Right.
So, yeah, the price might look good, but you still need to dig into their financials.
Yeah.
How much debt do they have? Are they making money? Do they have some kind of competitive advantage, like a strong brand or a unique technology?
Right. It has to be a good business to begin with.
Exactly. It's not just about a low price.
Okay. So when we talk about these quality companies, what are some of the things that Buffett specifically looks for? I mean, is it just about brand recognition?
No, it's much more than that.
Okay.
He really digs into the fundamentals.
Okay.
I mean, one thing he talks about a lot is looking for a company with a moat, which is basically a durable competitive advantage, something that makes it hard for other companies to come in and take their market share.
Right.
Could be a strong brand. It could be some unique technology they have. It could be a cost advantage, something like that.
Okay.
And then financially, he wants to see a company with a strong balance sheet, meaning they don't have a ton of debt and they have plenty of cash on hand. Consistent profitability is huge, of course. And he likes to see a history of good returns on equity. That's kind of a measure of how efficiently they're using their shareholders' money.
Okay.
And then finally, he wants a competent management team.
Yeah.
People he trusts who are focused on the long-term success of the business.
Right. So it's really about looking beyond just the surface level, right?
Absolutely. It's about really understanding what makes a business tick.
The article makes another really important point, which is about having a long-term perspective.
Yeah.
They point out that even if you buy a stock today and it happens to go down even further in the short term, if you're in it for the long haul,
right,
those short-term ups and downs are probably not going to make a huge difference to your overall returns.
Yeah, and trying to time the market perfectly is really difficult.
Yeah.
Almost impossible, I'd say. So much easier to just buy good companies and hold them for the long run. Let that compounding growth work its magic.
Yeah, which the article actually explicitly says that holding on for long term is the best way to invest.
I agree with that.
Now, what about Buffett himself? The article gives us a little peek into what he's been up to. It mentions that his company was actually a net seller of stocks over the past year, when the market was doing really well. But we don't actually know what he's been doing since the start of 2025 in terms of buying or selling.
Yep.
That information is going to come out in Berkshire Hathaway's 13F filing, which will be released sometime in May.
Yeah, we'll have to wait and see.
I guess the point here, and the article makes this pretty clear, is that Buffett's not someone who just makes rash decisions or acts impulsively. Just because he's been talking about market downturns as opportunities doesn't mean he's automatically buying everything that drops.
Right.
He's still very selective. He's waiting for those really good companies to hit the right price.
Exactly. Those wonderful opportunities he talks about.
So for our listener, what does this all mean? Well, the article suggests that understanding Buffett's perspective might actually help you feel a bit calmer. When you see all this market volatility. Instead of panicking and wanting to sell everything.
Yeah, don't panic.
His words might actually encourage you to see this as a chance to buy,
Yeah, absolutely.
To start looking for those smart buys that could really benefit your portfolio in the long run.
Exactly. I mean, market volatility is just a normal part of investing.
Yeah.
It's going to happen. There are going to be ups and downs. And sometimes those down periods, they're actually a chance to improve your returns in the long run.
Yeah.
Because you can buy great companies at better prices.
Right. It's about being proactive and thinking strategically instead of just reacting emotionally to whatever's happening in the market.
Exactly. Exactly. Use your head, not your gut.
So to kind of wrap up our deep dive here today, I think the main takeaway from this Motley Fool article and from Warren Buffett's consistent message over the years is that market downturns don't have to be scary.
Yeah.
For long-term investors, they can actually be a really good opportunity to buy quality assets, shares in well-established companies with strong fundamentals at more reasonable prices.
Absolutely.
And that's really the essence of a patient, long-term investment strategy.
Yep. Slow and steady wins the race, as they say.
And for you, our listener who's interested in gaining knowledge quickly and thoroughly, understanding this core principle, it can really help you navigate the ups and downs of the market. It's about cutting through the noise and getting to the information that truly matters.
Exactly. It's about gaining wisdom, not just information.
So here's a final thought for you to consider as we wrap things up.
Okay.
Given Buffett's focus on the long term and the fact that his company was actually selling stocks before the market dipped, it raises an interesting question. What are some specific things you would look at to decide whether a company whose stock has dropped a lot is truly a good opportunity for long-term growth, or whether it's actually a risky situation that you should avoid?
Right. How do you tell the difference?
It's definitely something worth thinking about as you do your own research and make your own investment decisions.
For sure.
Thanks for joining us for another deep dive.
It's been a pleasure.
We'll see you next time.
See you later.